Alrighty, ladies and gentlemen, we're back for another one. We have a lot to cover here. So if you're just joining me right now and this live has been recorded, if you pay attention, there's a lot that you can learn from here. We're going to go over a lot of the data that's going on, what old Papa Powell is going to be talking about. You're going to hear a lot of the same things, a lot of different jargon. If you don't know, you keep on listening, you will know very, very soon. We do live trading, live commentary, we talk tickers, and we keep this thing chatting, guys. We keep this thing chatting, and we have the best moderator in the whole town. That's Dan Bob Dan. Thank you for joining up. And guys, let me just go ahead and make sure we got everybody that we need to in here, and then we're gonna do a very deep dive. Remember, in a very short time, we have the Fed rate hike decision. That is in about an hour and 15 minutes. It's very, very important. If the Fed rate hike decision, they call for that 5.5%. If it goes either way, you're gonna see crazy volatility in the market. I think we're gonna see crazy volatility anyway, but we're going to wait to find out. So let me go ahead and push this out to a couple of people. Let me make sure that we have everybody that we need to in here. We're gonna make sure that we are all caught up on all the economic data. We have a lot that came out today, and you can see that in the market. Right now, I'm just short on energy. It looks like energy is failing, and we can go over that in a little bit. But my main thesis, guys, is the S&P 500 holding this $500 area, okay? I think that that is a very, very key area. I've been talking about this since yesterday. We went all the way as low as $499.81, just breaking down that $500 area, got soaked right back up, and we've been trading sideways as we usually do before an FOMC Fed rate hike and meeting. The meeting comes out at 2:30, so let's pay attention to that. I'll definitely be bringing that up and making sure everybody knows what's going on there. So let's go ahead and go over a few things. So we already went over the fact that we have the FOMC statement, or the interest rate hike decision, at 2 o'clock, 2:30. Old Papa Powell is going to come out. He's hopefully won't drop the mic, and we can stay above that $500 area in the S&P 500. We also have, if we look at the QQQs, we can see the QQQs is doing the exact same movement. We're just trading sideways just under in that VWAP area. So let's go ahead. Let's get the rest of the people that we need to in here. We want to make sure we got all our fam. Yes, sir, Bob. Dan Bob, I do appreciate you, brother. You're the man. We're gonna go ahead and make sure we got all of our Facebook friends from Robinhood Stock Market Watch List. It's always nice having them in here. I'm gonna go ahead and pin that up for the group there. And I will also post that in mine. So guys, if you're not aware of it, you can click the description. I got a link tree. You can follow me on all different platforms. I don't know what you use, but we post on all of them. Our main platform is going to be right here, YouTube, baby. If you want to find me anywhere, all the hottest data, news, all that BS, it's right here on YouTube. And enough of that said, we are pinned, we are posted, we can get into it. So we know for an absolute fact that this S&P 500 came all the way down here with the 6-day sell-off. After it bounced at 493.66, we've seen a nice pop. It came right up here below this 21-day moving average. Now, if you guys don't know me very well, this 21-day moving average is absolutely pinnacle when it comes to the S&P 500. If it's below it, I don't trade. If it's above it, we look for swing trades. We just barely got above it, but what was right above that? The 50-day moving average. That's where institutional ownership is looking to buy or sell. If it's below the 50-day moving average, those institutional ownerships usually stay hands off. They're usually selling, okay? And that's exactly what happened. We popped up above the 21, smacked our head on this 50-day moving average, just as we talked about on this huge pullback, this big pop into the 50-day, and now we're pulling back. The question is, do we hold this $500 area? If we can hold this $500 area, you know for an absolute fact that that is bullish. It's holding a psychological area. But if we break down from this $500 area, that's going to look really, really bad. Now, with the FOMC meeting coming out, guys, with that FOMC meeting coming out, if we take that Fed rate interest decision and it's 5.5, as the CME Fed Watch tool talks about, If we look at May, I've been saying in May we stay. Let me scooch this over so my big head's not in the way. In May we stay. What has changed from this Fed interest rate, this probability, target rate probability for May? The biggest change that I've seen in this in the last couple days is right over here. That 5.50 has a now 1% chance of actually going up. We didn't see this before. In May, we were to stay at 99% or a 98% chance with a 1 to 9% chance at the time of a rate cut of 0.25%. Now, if you look down here, this little sliver, it's actually showing that we have a very, very small percent of chance that we could actually move up 0.25%. So if that happens, if we do move up 0.25%, which I doubt we're going to, but if we do move up, you can expect the market to tank. I mean, it's going to get so heavy so fast because it'll be so unexpected. I doubt that that's going to happen, but I will say that that is the change in this market right now. That's the biggest change. That's the biggest thing that has changed in this overall market is the simple fact, let's see, you're on FM again? Yeah, baby. That's right. Let's go. I'm in the tunes. I'm in the ear. What's up, Predator? Glad to see you here. Dan, Bob, Dan, as always, glad you're here. Let's we're gonna get the rest of the crew in here real quick. We're definitely gonna have a big live stream today with the rate hike decision coming in at 2 o'clock and Papa Powell dropping the mic at, well, hopefully he doesn't drop the mic at 2:30. I have a good feeling today's going to be a big day. So May 1st, we actually have a 1% chance that we could go up in a rate hike, but it's most likely May we stay at 5.5%. So why do I think there's still going to be volatility? Well, when Papa Powell gets on that microphone, when he starts talking, which you guys will see here, I'm going to stream the whole thing. I'm going to let him take the mic. He'll be my guest. I'll let Papa Powell take the mic, I guess. And you guys are going to hear exactly what's going to happen with old Papa Powell is he might come out a little too hawkish or a little too dovish. And whatever he starts saying, if it's not the same old, we're just going to fight this inflation, we're going to stay at 5.5%, we're dedicated to keeping that. And if he says the same old stuff we've heard in the last two meetings, then I think the market will take it neutrally. But if he comes out hawkish or more hawkish, saying we might not cut any rates till the end of the year, we might not do this, or we might be more hawkish, we might have to raise interest rates, or I'm willing, even if he says I'm willing to raise interest rates if we continue down this same path of hot PMI and CPI and PPI, if all that continues to come out hot, I'm willing to raise interest. If he says that, I guarantee this market is going to get very, very heavy, okay? Now, if he says, you know, I've ingested this data, it still is looking good, things are still looking, you know, strong in this overall market, the economy's growing, the jobs are growing, and the inflation, sure, it looks a little warm right now, but that's normal, you know, blah, blah, and he comes out like I sound, like happy and dovish, and if he comes out talking like that, his hair's not all ruffled and feathered up, you can bet the market's going to take that in a positive way. We'll stay above this 500 and we'll head higher. So those are my two scenarios. But just remember, guys, when we go through these, May we stay. In June, we still have a percentage chance over here that we're going to raise. We only have a 9.5% that we're going to lower. Other than that, it's almost looking like June is to stay as well. July still looks like we are going to stay with only a 21% chance, showing that we might come down in 0.25 percentage point. Now, September is our only inclination that we might actually lower those interest rates, and that is in September. Okay, September we're at a 37% chance, as to where last week we were at a 50% chance that we're actually going to cut those rate hikes. Okay, so now the way the data is looking, in September we have a lower percentage chance that we're going to come down. Okay, it was closer to 50-50 last week. Now if we look into November, now we're getting around that 50-50 on 0.25 slash. So now we're only looking at maybe 1, possibly 2 rate cuts by the end of the year. Okay, where we started off as 3 or 4, then we were down to 3. Now we're looking like we're down to 2. You know, if we keep on coming down, guys, we might actually not get any till the end or until next year. Okay, Now, one thing I do want to bring up just so everybody's aware, let's bring up that inflation data. I do like bringing up the inflation data just because the inflation data is really important so we're all aware. This here is what I like to use, what I like to show everybody. Not this, but this. Okay, in 2014, we had inflation sitting around 0.8%. Okay, old Papa Powell's goal is to get that inflation down to that 2% area. That 2% area is the sweet spot for inflation. Smoke a bowl of hopium. June we boom. Yeah, baby. Let's hope. Let's hope. I hope for everybody's 401k, for their Roth IRAs, that we do boom. But now looking at this data, we're at 3.5% on our inflation, and we're going to be coming out in April, so last month, we're going to be coming out with April's data in May. Okay, it'll be available in May. On May 15th, we'll come out with what the inflation rate. Okay, the inflation rate will tell us if we've came up or down from the previous month, March. Okay, now you can see since January, we've came down from last year, but we've been slowly and gradually rising from January till March. So that can be a little debilitating if you aren't careful, because we are worried that inflation will start running rampant again, and we don't want that to run rampant. Let me get a sip here, guys. I just came back from jiu-jitsu, so I'm thirsty as hell. Probably shouldn't be drinking Monsters. Probably go grab a water, but you know how it is. So right now, we're just lingering in the S&P 500 right around that $500 area. The only current position I have right now is EGY. I actually took a short on this using this high of day once it broke up above this VWAP area. I was just looking at XOM with the crew this morning, and I noticed that we broke down, and we broke pretty hard out of that consolidation area. We looked at everything, and we could see that we had points of contact 1, 2, 3, and 4. We broke above this point of contact, came back down, we bounced, we made a new lower high. Okay, here's your high, here's your new lower high, and then once the earnings came out, we broke down below it. We came back up into that resistance. Let me zoom in so you guys can understand this better. We bounced up into this resistance area, and then we started heading lower, which is showing me that this is a weak sign. Okay, if we made a new high, we broke below that area of support, which should have been support, then we broke up through it like it's not there, and then gapped down below it. Now that's going to act as resistance, and that's exactly how it acted. So the next morning it started to fail. I wanted to find something that moved relatively faster, so I looked at EGY, and it looked like it would be following its counterparts of XOM being the leader, EGY being the lagger, so I shorted the lagger. And right now you can see it's paying me pretty well. I just took a small 1,000 shares in it. I know it sounds like a lot. I am looking to make $1,000 off this. I think this can come back down to where it gapped up at, but I'm up about $202 on this right now. That's nothing. That's pennies, pennies compared to where I want to be. Good thing this thing didn't stop me out, because I only had 50 shares for a stop out instead of the 1,000 that was up there. Whoopsie. So as we go down, guys, if we do break this $500 area, I will be buying up in the S&P 500 as we continue lower. Now, of course, I do, and always, hey, Zamora, she is in the building, baby. I'm glad you are here, Zamora. So we want to keep an eye on the S&P 500. If it does break down from here, I always give a little excerpt when it comes to dollar cost averaging into the overall market. We want a dollar cost average into that market. It's good for your long-term account. Okay, I like to have a nice basis. I like to usually keep a quarter to half of my capital in the S&P 500 using VOO or VTI. It just helps me keep a nice general basis there. So I am short on energy just because of the old XOM and their earnings and the gap up into the resistance, and then it started to fail. So we're just kind of holding on to that, and I took a little bit of a faster name for that. So we're going to see what happens with that as it continues lower. If you're just joining me, thank you for joining me. We have at 2 o'clock, we have the rate hike decision. At 2:30, we have Papa Powell coming out. Hopefully he doesn't drop the mic on us, doesn't drop it like it's hot. Other than that, guys, we are just going to make sure that we keep a good eye on everything in the market. If you guys have any questions, Zamora, let me in, let me in. It just reminds me of that meme, you know. I love it. But I'm glad you made it. I'm glad you're here. So let's run through the overall indices, and then we'll go back over the data, the current inflation report, what the Fed is expecting to raise those rate hikes. We'll go over the data that has already came out leading up to that. And then, of course, if you guys put any tickers in the chat, we can always go over that. But today is going to be a beautiful day. Whether it's green or whether it's red, we're going to see what wants to happen. So let's get our boy Adam in here. I know Adam said he wanted to join up as well. So we'll get Adam in here. Yeah, there we go. Let's see what we can do here. So we're going to start off by going through the indices. We're going to go through the S&P 500, lingering around that $500 area. As you guys know, I want to see it stay above this $500 area. We previously broke down below it by just $1. Not even $1. We actually broke down by about 20 cents, you know, close to 20 cents, not even 20 cents. So about 14 cents we broke down that S&P 500. Now we're just lingering around like some bad breath here, which we usually do before a Fed rate hike decision. As you guys know, if you've been with me, which I'm quite a few of you have, during these FOMC meetings, we usually just channel sideways. We usually make a range and we just bounce sideways. Whether the Fed's talking or whether we have a Fed rate interest rate hike decision, we usually just trade sideways for a while, and then we usually make a decision after the market, after Powell comes out and starts jibber jabbering, or we have that decision. The QQQs is doing the same exact thing, just trading below that VWAP area. We do have a small downtrend on this. You can see from market open, you can see this thing slowly downtrending here. We'll just mark that out so you get a better broad idea of the way it's trending. Let's look at the IWM. So I noticed the IWM wasn't selling off nearly as hard this morning. We actually had a nice pop this morning in the IWM. Not to say it's showing strength over the indices, but it definitely is doing its best to maintain its due diligence on staying up there. Now SMH, that's a different story. That thing sold off pretty hard, and we'll go over some of the semiconductors. I see Zamora with NSC. We'll look at that in just a minute here. I'm imagining that's probably silver you want me to take a little peeky gander at. Let's see what our boy Adam had to say. Yeah, Adam's in. Well, Adam, say hi in YouTube. We don't want to hear. I don't want to hear you saying hi in Discord. Say hi on YouTube, brother. It's good to see you. Our boy Adam's in here. That's my right hand. I am pumped that he is here. We got the RSP, so the RSP is looking very bad too. The thing that's different with the RSP is it's not trading below that VWAP area. That's the only real difference here, guys, is that RSP is the equally weighted average over the S&P 500. Now everything's below its key moving averages, and those moving averages are curling down. So it's not looking good in the overall market, but I believe after this rate hike decision, we'll have a general direction. Can we continue to smoke that hopium? Can we continue to believe that the overall indices are going to trail higher and above that 500 bill? Or do we head lower? Do we continue to head to the sell side? Do we have a 6 day in a row, red, and we continue lower? Well, speaking of lower, Bitcoin is doing the same damn thing. It broke that 50-day moving average about 3 days ago, and it started heading to the sell side. So the question for Bitcoin is, will we find an area that it will hold? Well, when we started to make this pennant here, once we broke that pennant, I don't know if you guys can see it on my screen down here, but we had this beautiful pennant, and when it broke this pennant here, that was a big inclination that Bitcoin was going to continue to sell off. The only thing that was saving it here was this 50-day moving average. That 50-day moving average wanted to hold, and it could not. It broke the 50-day moving average as well. And now that we know that institutional ownership is in Bitcoin, that is definitely one that we are going to watch every day. Now gold, let's look at gold. I told you guys over the past 2 days that I have been very bearish on gold. Why? Well, I've had the general public start asking me about gold. When you and I, people like you and I that like watching this stuff, that like going on lives and listening to a big chin talking about different indices and what's hot and what's not, We are first. We are first. If you're here with me, you're hearing it first. You were seeing it first. We know exactly what's going on in the market while it's going on. And then when you have the general public coming to you and saying, hey, you know, I was thinking about buying some gold. What do you think? They always are buying at these highs. Just that, I literally just was talking to people like 3 days ago. It was at my grandfather's birthday party, okay? And I'm sitting there talking, and I had two people come up to me, and they're like, hey, you do that stock market stuff? I said, yeah. You know, what do you got going on? Well, I was thinking about buying some gold stocks. What do you think about gold? Or should I just go buy gold? And I said, well, gold's up right now, but, you know, I really don't know if it's the best time to buy. I would imagine, you know, it's up pretty high. You might want to wait for a pullback or something. Well, when people that aren't in this realm start asking you about that, and I've heard it in the Market Wizards books too, when people that don't usually play those stocks, they're usually buying the highs, and that was my biggest inclination. Now, we also can see here we're breaking a 21-day moving average. So this pop right into this 21-day moving average, this might be a key area where we might want to short. Now, these aren't buy or sell recommendations. These are my thoughts. I could be wildly wrong about anything that I say here today. So these are not buy or sell recommendations, but I'm seeing what I see. I'm seeing what I see, and this might be a good area for that. So Barracks actually came out today. You can see also with Barracks coming out today, you can see that earnings came out. It showed that they were up a few pennies on their earnings, and they still sold off pretty hard here. So unless Barrick wants to turn around on this area of support at 1620-ish, it looks like Barrick Gold might actually continue lower right on top of that 200-day moving average as well. And guys, we had a few other things come out like Root. Dan Bob says, Adam, the brains and the wisdom of our crew. He's on 20 ladies on his way being a millionaire. Oh yeah, he's 20. No, he's a little older than that, but he's on 20 ladies and on his way being a millionaire. I don't know how to take that, Dan Bob. That could be taken. That could be skewed very bad. Like he's some kind of you know what. But no, he's a good dude, and he is my right-hand man, and I'm very, very proud of him. He's going places, and we are happy to have him on our team. We always want smart investors, very knowledgeable people on our team, and he is one of those. So that's why I say he is my right-hand man. He is my rock. You're my rock, brother. Brother. Anyway, Root actually came out with earnings today, and they were a lot better than they expected, popping right up in this resistance. Why do I call it resistance? Because it's all-time high. Well, the market is failing very, very hard, and that's exactly what Root did right at open. It failed hard, and now it's continuing lower, and that's very unfortunate because, oh, he's only 20. Okay, yeah, thank you, Dan Bob, for fixing that. We don't want the ladies out there thinking he's some kind of gigolo or whatever. I don't even know if I can say that on air. Let's take a look at the VIX Volatility Index. I want to continue on with this though, guys. So the Dow Jones Industrial, we got it sitting down here at support. I call it support because we've hit it 1, 2, 3, 4, and 5 times now. We're down here at the 6th time. Can it make a new high or low? It currently is trying. So I think if the S&P 500 can hold that 500, but I feel like this is our final frontier, guys, on a lot of these indices. So if we break down from here, we're going to continue lower. If we can hold this area, I think there is a possibility where we can get back up above that 21-day moving average. If we can do it on volume, that will be a beautiful IBD investors follow through day, and then we can continue searching for longs for swing trades in this market. We'll see if this looks any better. All right, so now we have the dollar. So we had a big pop on the dollar yesterday. We continued higher, and then we're now closing, or right now we're basically right at where the dollar closed yesterday. So we're at an area of resistance up there at that 106.50. So we want to see if we can continue to head lower. Remember, the dollar has an inverse correlation with the overall S&P 500. The higher the dollar goes, that means the S&P 500 will usually go lower. If the dollar is going lower, it usually has the inverse correlation where our S&P 500 will go higher. Now, VIX Volatility Index looks like it is around neutral. We don't want it to go too much higher than this. That's when the selling or the fear, this is the fear gauge, as I like to call it. VIX Volatility Index just shows how many shares are being traded all at once. It's the volatility index. Usually if you have a lot of volatility, that means that there is a lot of fear in there. There is Covey. What's up, big dog? Hope everything's going well for you, brother. QCLN, we're not going to go through the treasuries. I just like to have them on here so I can help learn and understand the correlations in the overall market. NVIDIA. Now, guys, we talked about NVIDIA. I said my final frontier on NVIDIA was on this downtrend. You can see this big downtrend right here. When we broke up through it, I was bullish. If we break down below it, I am bearish. We are through it. I am bearish. We might pop up and then find that area as resistance again before we continue to head lower. So that's NVIDIA for you. SMCI had earnings yesterday. They failed. They had a nice pop in the pre-market, but then sold back off again. We're right there at those lows of 722.19 for SMCI. Now Tesla, good old Uncle Tesla had a beautiful pump on volume just the other day. This blow off top on the volume seemed to be selling off now with the rest of the market. Now I know Tesla likes to do whatever the heck it wants. Hey, mama, yeah, I know it's hard to pay attention, but you know what? You're here supporting your boy. I appreciate you. Thank you very much. Shout out to you, old Ginger Hopper. Mama, what up, mama? So next up will be Netflix. So Netflix might have I call this the big drip, guys. The big drip, if you could just take this piece and move it up here, that's what the big drip would look like. But if Netflix breaks down below this key area, look at this gap here. You see this gap? From 495.11 to 536. If this breaks this gap, I think we have a big move ahead of us coming all the way down to this 200-day moving average. Okay, this big gap is showing that there is a big price gap here, meaning there's not a lot of people that are going to try and defend this area. They'll try and defend this area. They'll try and defend this area. But it is less likely for anybody to be in between this area right here. So if this starts to keel over, this might be a very big trade. So I'm just actually going to mark this out, guys, now that we're going over it. And this is exactly why we want to do this. We want to make sure we have an idea, an inclination, if you will, that it will come down lower or higher. We get our plans. We see what our best trades can be. Nylish is in the building. Bleed red, he says. You know what? That makes me want to do a quick start. We're going to start a poll here, guys. Will we break that $500 area on the S&P 500? Yes. Bleed red, or no, green is the way we go. We'll add one more option. I don't know, just here for the big chin. There we go. All right, we got a poll going up, guys. Go ahead and let me know what you think. I am actually really curious what's going on with you guys, what you guys think with the overall poll. Now, personally, I think as long as we stay above that 500, we can continue to be green. But if we go ahead and head on lower, then I think, we might break and we will bleed red, just like Nylish said. Getting off into bed in between patients. Well, I appreciate you popping in here, Nylish. Get out there. He's the one out there sticking people with needles, but we appreciate him. You can leave me up in the background if you want to. You know what? While they're getting stuck with needles, I'm sitting here like, Netflix is going down. It's bleeding red. Everybody sell. He's just sticking people with needles, trying to keep them alive, keeping them calm. Oh, that would be bad. But anyway, guys, let's keep on keeping on. So we got Netflix down here. Like I said, I believe if it breaks this area, this might be a key area for Netflix, and then we'll fill this gap right here. So I do think it has a big potential to fail in this area, and if it does, I will want to be a big part of that. Microsoft next up. We can see Microsoft well below all of its declining moving averages. This is not a good look for Microsoft. This might be a nice pullback. Hopefully it doesn't look like the bear market that we had back here in 2022. That was not pretty for anybody that was holding anything. Hopefully we just continue to act like this is a minor sell-off. Let me get a sip real quick. All right, next up, AMZN. AMZN is still in that area of consolidation, that area of support. We don't know if this is going to be support or resistance yet. It either needs to break above or below this and then show. Now, this kind of looks like XOM where it broke down below it. It popped back up into it. Now, if it bleeds back out of here, it's less likely to pop back into this and travel higher. It's more likely to pop back up into this and then fail. So right now with AMZN kind of looking like AXON where it broke down, it popped up. If it breaks back down, we're probably gonna head lower in that area. But if we can get up above, get a big breath of fresh air, and we don't sell off at 185.50, we might be able to head to the north side. So Meta is kind of looking like Netflix, only it has a less of room to fill that gap. That gap is, only what, 20 or 30 bucks. So 40 bucks, where that's only $40. But it is looking like Netflix where it sold off hard on earnings and then has an area below it of a gap. AAPL, we were talking about this just yesterday, how I was very bearish on it just because it was popping up into this downtrend, and for it to get through that downtrend, it's going to take a lot of volume. It's below a declining 200-day moving average. This thing has a chance of continuing to head lower. We got a nice pop this morning. If you guys remember, I tried to take a small short on this. We were down about 40 bucks on that, but we ended up coming out on top anyway with NVIDIA, shorting NVIDIA. Now, if we look at NVIDIA, I wish I held that short all day. I'd be up about 3K, but shoulda, coulda, woulda. That's not here. That's not nor now. I'm not going to learn anything from shoulda, woulda, couldas, so we'll carry on. Now, Google was popping up very well this morning, but Google has been trending down ever since it had that rip tater chip to the north side. Now that we've popped up and headed back down, we still have to look at Google and say, this is a leader in the market. This is an absolute true leader in the market. Why is it a true leader in the market? Well, look at where Google sits. This is one of your biggest tech industries, okay? And it's above all of its moving averages, and all the moving averages are to an incline, guys. They're still moving to the north side, okay? So that being said, we want to recognize this as a leader in the market, okay? So Google is really the ultimate leader currently in the market, being one of the biggest stocks out there, and it's still above all of its moving averages, and it's holding up there pretty well. So even though we had this big push and a big sell-off here the past 4 days, that does not matter to me. What matters to me is this daily chart, the fact that it's up, it made it to all-time highs, and now it's digesting that with all the current data that we have going on. Now, I do want to remind everybody, what are we here for? We are here for the Fed rate hike decision. That Fed rate hike decision is going to be here at 2 o'clock. So we have about 40 minutes till that Fed rate hike decision comes out. We are expecting a stay. We are to stay. 5.5% is what it should be. If it comes out hotter than that, that's not going to be good for the overall market. That is going to be very, very bad if he raises interest rates. The likelihood of him doing that is only 1.1%, with the current U.S. inflation at 3.5%, and the data coming out hot. We're a little nervous that has that possibility, but it is very less likely to do so, as to where we probably are more likely to hear him say something during the meeting where he doesn't think we're going to get any rate cuts for the year. And if he says something like that, that is going to be very, very scary. That's not something that we really want to hear old Papa Powell say. If he says something like that, then we are in for a very, very rough ride. Now, if you'll bear with me, I'm going to go ahead and look up where I can find, let's see, let's go, we're going to make sure that we have, I want to go to the Federal Reserve. That's right. I'm headed to the Federal Reserve right now to make sure that we have the FOMC press conference up It's going to start at 2:30 today. Remember, the Fed rate hike decision is at 2, and then at 2:30 today, we are going to have that meeting, and we're going to make sure that we have that up and streaming for you. We want to make sure that you hear it here first. So I will make sure when it comes closer to time, I'll have it up. I'll have me out of the way. I'll put old Papa Powell up. I'll let him take the seat. And we're going to let it stream, guys. We're going to make sure we have the S&P 500 up just like we always do, so that way we can watch and see what old Papa Powell, what he says and how it gets ingested in the overall S&P 500. I tell you what, it's one of my favorite pastimes. I know I'm a nerd. Like, instead of watching the Super Bowl, I'd rather watch what Papa Powell has to say and how the overall market ingests that data. So let's go ahead and go over, let's see, Zamora says she wants me to look at NSC. All right, so that's Norfolk Southern Corp. Let's read what NSC is. Maybe we can figure out NSC. We can figure out why she's looking at this. So it's transportation railroads. All right. So Transportation Norfolk Southern Corp is a transportation company that engages in the rail transportation of raw materials, intermediate product, and finished goods. The company also transports overseas freights through several Atlantic and Gulf Coast ports. Its services includes property leases and sales, wired line and pipeline, and fiber optics. So they're not just the railways, guys. They are wired lines, pipelines, and fiber optic projects. Access properties, managing private crossings, promoting businesses with signboards, and natural resource management. So they do a lot more than just railway. So let's maybe take a little peeky gander at the overall chart and see maybe why did she bring this up? Well, if we look at this, we can see it was on a downtrend for an awfully long time, getting a beautiful pop and a breakout above this, curling back down now. Let's see how it's going to act around this 200-day moving average. Now, we had the earnings come out and they had a small, not a beat, the opposite of a beat. They got beat down on their earnings just a little bit here. And you can see they took it poorly. It failed down here, and now it's trading at 230.79. If it can bounce off this 200-day moving average and show its support, start curling up, make new lower highs, this might be something formidable, but it is quite a slow mover at 2.4%. We want to see this thing really pick up some pace before it lands on my watch list. So let's go back to NVDA. I want to see how that's doing down here. We'll throw this up on the 1 minute just to really see. So it looks like we're getting a little pump there from NVIDIA. Let's see the S&P 500. Let's see where we're at on that 500. Look at this nice little pump coming from. Now we're just, see, this is what I mean by range bound. We're just bouncing in between this range before that FOMC meeting comes out, before the Fed rate hike decision comes out. So it's not all too, hearts, kisses, and rainbows in this area. We're kind of just hanging out in a range, which is a-okay for the overall market. It shows that people are a little weary. QQQ, look, we're right back up at that downtrend. I wonder how that's going to take effect there. If we watch QQQ, this would be like an area where we could short. We could take a tasty little short right here and watch it head down to the sell side. You could even look at SQQQ, which is the inverse correlation, and you can see there's an uptrend here. We could go ahead and try and buy. Like, I'll just show you guys. You could buy. Buy right here, and then if it broke this trend, we could get out. Just a simple trade, just like this. We make this trend. It's not as pretty as the QQQ. So if we go back to the QQQs, let's look. So we're going to give this some time. If it breaks up and gets a little too high above this, then we go back to our SQQQ, and then we make sure we sell out of it, right? So it's just as simple as that. The SQQ is considered short QQQ. So if you buy, this might sound confusing. So if you buy the SQQQ, basically you're buying the short of QQQ. It's good for smaller accounts that can't short right now. So if you're looking at QQQ and you're expecting this to come down, like I am right here because it's on this downtrend, and QQQ does come down, then we can look at SQQQ and we can take it for a long. So that way, if it pops up here and starts to head back up to these highs, then you can make that money that way. Okay, so we're up about $8 on that, but what we're looking for is this to come back down in this range, come back down in around this 420 area. If it doesn't and it pops back up above this area, let's say if we get 20-30 cents above this, I will be out of my short trade, but it's just simple trades like that. That's what we're kind of looking at, guys. This is what I mean by technical analysis. If anybody says technical analysis doesn't work, have them come watch my channel. It's real simple. I make live trades. I do live commentary. I show you exactly what I'm going to do. I tell you exactly how it's going to work out. Sometimes it does, sometimes it doesn't. But if you pair technical analysis with risk management, you can make money. Everybody can make money doing this. It just takes some time. It takes some effort. And there we are. We're up $11.20. Maybe we give this, I don't know, we'll say to the top of this, so 12.24, and then we'll take our 500 shares out and we'll call it, you know, easy money. You know, that's what we'll call it, just easy money. You know, it's nothing, it's really nothing to like brag about. It's nothing to, you know, it's just, you see a trade while we're in the middle of talking here, you take the trade, you call it a day. S&P 500, same thing here. We're on this beautiful downtrend now. It's not really made it up to that downtrend. We still have a little ways to go. What stopped this from continuing higher? Right here, this VWAP. So this is volume weighted average price. That's what seemed to stop the S&P 500 from going much higher. We still might go up, run into that downtrend, but I doubt it. That's usually a pretty good area. So we'll see what the QQQs want to do right here. But we're up about $7. We'll come back to that. I want to take a look at a few other things. EGY, we're up about $217 on this. I see you guys smashing the 100s and the hearts down there. I appreciate that. You know I love it. If you haven't already, hit the like, hit that subscribe button. If you're new with us, we are here every single day. We at least bring you at least a short bite-sized data. We go live. We meet up in the Discord. If you're not part of the Discord, go ahead, join up. It's absolutely free. Dan Dan already put the Discord in the chat for you. It's only a few, just a scroll away, guys. We meet up soon it'll be every night. Right now it's every morning at 8 o'clock. We go through the market. We figure out how we can make some money, and we figure out what we can do from there. And then, you know, we take trades. We make money, and it's A-okay, baby. It's A-okay to make money in this day-to-day. Now, if that doesn't interest you, that's A-okay. I still appreciate you being here. So let's go back. Let's run through this really quick. So S&P 500, we are still in that area, that trend area. Even if this thing comes back up, it can come all the way back up to 501. It would still be in this range. Okay, it can break its trend to the north side. I'm rooting for this to actually break. We want to see this stay higher, but I tell you, none of this, you can erase all of this from our memory here if the old Papa Powell comes out and drops the ball, or those Fed rate hike decision comes out as a hike rather than a stay. You can bet your bottom dollar if any of that stuff happens, then we are going to see a huge change in this market. So here we go. The QQQs might actually get up above this trending area, but I'm going to give it some time. Like I said, I'm going to give it up to 21.96, 421.96 before we head back over to SQQQ, and we'll get out of that trade. But we're down only about 30 cents, about $2 now, and we'll see what it wants to do. But I'm just playing off these trends, guys. It's real simple, real easy, and we're not playing for anything crazy because we don't really care to play in this rangy crap. It's very slow. It's very unvolatile. You're not going to make a ton of money doing this. So I'm just going really, really small because we don't want to try and go crazy. My boy Danny is out at a party in Finland. That looks awesome. Nice. Wish you were here with us, Danny. So what do you guys got? You guys got anything that you need me to go over? Anything? You know what? One thing that I want to go over is V. So V, if we bring up V right here on this, it hit my alert on this anchored VWAP. I was thinking about taking a nice size on this. I decided not to just because of the FOMC meeting and everything going on, but my alert went off for this. And I was wondering, you know, what's going to happen here? Anchored VWAP off of its previous low. It gets up high, has a nice pullback, and then we're right here at this anchored VWAP. So I'm going to keep an eye on this. I've been playing anchored VWAP for a couple weeks now. I do like to see this and would like to see this continue to rise higher to help prove and strengthen my general consensus around anchored VWAP. So right now you can see it is bouncing off of normal VWAP. This is the daily VWAP. Anchored VWAP just means I've anchored it to its previous lows. I believe it was this was its previous lows, and that's the anchored VWAP. So it just kind of like came right up to that area and now is going to bounce off of it. It bounced off beautifully. We're going to see if that wants to continue to the north side. So the S&P 500, right there we go. Now we're back up, just like we said, right up into that trend. We're going to see if it wants to break down from here. Let's take a look at the Qs now. Is it time to get out of this just yet? Nope, it looks like it made it up just a little higher. It's starting to roll over here now. We're going to see, and what I can do now is I can go to SQQQ and we can go ahead and put our stop loss. That's what we can do, guys. So I don't even have to watch it anymore. I could go ahead and put a stop loss on this. So we have 500 shares. This can be the stop loss. So let's say I get to talking, I forget about what's going on. I put a stop loss here because if it breaks down this area, I don't want to be a part of this anymore, because that is going to be my area where I've decided that's where I lose. That's where I am wrong. I don't want to hold on to this thing hoping it's going to come back. Okay, so this is where I'm wrong. If I'm wrong, I'm wrong. That means my trend that I have drawn is being broken. This thing is going to head lower, but right now, you know, we got time. We're going to sit back, relax, just take a small trade for the tube, baby. Take a little trade, and if this is bringing you any form of entertainment, go ahead, leave a like, hit that subscribe. We can look at financials right now. That's XLF, if I do remember. That is the financial sector. And you can see this is the ETF on the financial sector. We had a huge push up here. It looks absolutely beautiful. We made new highs on the financial ETF, pulled back. We were testing this area for support. We popped back up, and it does look like it is doing well right now. Now, let's go ahead and put this on MarketSmith indicators, and we can see that we are trailing just below a 50-day moving average, but above a rising 200-day moving average. The relative strength rating on this is 91, so that is showing that it is a hot sector. So we want to keep our eye on the financial division. So in the financial division, that might be a good reason why V is doing well. You know, we might have a few other ones that are going to be doing well in the financial division. And Dan Bob, if you want to throw a few my way, you're more than welcome to. I believe there's, you know, Goldman Sachs, which I believe is what, GS, correct? It is GS, and you can see GS is doing well at all-time highs just 3 days ago. That's looking very, very nice right now. What's a few other financial, let me see if I can remember. Yeah, I don't know. Throw them up in the chat. What you're watching, Dan Bob, on the financial division. I might actually have some in here. I could look up the financial division. Let's see. A, B, C, D, E, F financials. Yeah, we can go through the financials. Yeah, we got JP Morgan. I should have remembered that one. We got JP Morgan, so that's above a 50-day moving average, so that is actually looking very well. We have Wells Fargo, WFC. That's trading right now at 59.58 up there as well. Actually, that's looking really tight, Dan. Look at Wells Fargo, just like this. Look at that. Now that is pretty. That's something I want to see. Healthcare and utilities, yes, sir. Those are looking very, very good as well. Yeah, so this is the trend on the financial. Now this is a double whammy, guys. So let me bring up the fact that Wells Fargo is a slower mover, only at 2%, okay? Only 2%. So what am I looking at here? Well, it's slow. It's a slower mover. Now, that doesn't mean that we can't play a slower mover. I'm just saying you can't expect to be up or down thousands of dollars. Speaking of thousands of dollars, let's look at EGY really quick. All right, we're still up about $222 on EGY, so that's looking good. Let's go back to Wells Fargo, though, just because we know that the financial division is looking hot right now. We look at the ETF. We know it's up around that RS rating, relative strength rating of 92. So we know the financial division's doing well. Now, why am I getting excited about Wells Fargo? Well, Wells Fargo already had their earnings. That's a good sign. We don't have to worry about that. Wells Fargo also had a push up over top of this area of resistance. Why do I call it resistance? Let's zoom out here on the weekly, and you can see we've had an area of resistance 1, 2, 3, and 4 different times. Huge cup here. A couple of years later, we break up above it. Now we come back down. We are retesting that area. So that red line, we need to remember that that red line is a key area here, guys. We could even bump this up. We can scoop this up just a little bit so we can see right where it's at. So it's trading right there at that area. So now let's go back to the daily, okay? Now, if you look at this daily, you can see we had a nice push up above that area. Now it's came back down and now it's retesting this area. It's getting very, very tight right on a 10-day moving average. That is showing me a lot of strength. So this is what I'm going to do. I'm going to set my alert for the high of this day's candle. Let's say financials continue to stay hot. Wells Fargo breaks up above this on volume. Maybe I take a little trade holding on to this, risking previous day. So it'll be a small risk for a huge reward. So let's put Wells Fargo, even though it's a slower mover at 2%, let's put that on our watch list to see if we can get bigger and better moves. Let's go ahead. We'll continue through the rest of the financial sector to see if there's anything else in this that we can take advantage of. So we have Citigroup. You can see Citigroup has been moving up. We have GS, which is Goldman Sachs. We already looked at that. I actually had this marked out before, where if it broke above this, we were going to head higher. It did. It came back and retested. Guys, I've told you about this retest multiple times. This retest is very, very important. When we break up and we come back down and retest these areas of support that were resistance are now support. Bouncing off of it, heading higher. This GS, or Goldman Sachs, is much higher. It's a little extended from the 10-day moving average, but it is also looking very, very well. Now we have Bank of America here too. BAC. BAC is looking a lot like Citigroup as to where it still has some room to go up here, but we still have some overhead resistance, so not as good as Goldman Sachs or WFC, Wells Fargo. Thank you for joining me, guys. If you're just joining me, we will be going over the Fed rate hike decision that's coming out in about 23 minutes. So make sure you stay tuned. Just after that, 30 minutes after that, we have Powell is coming out. He's going to hopefully not drop the mic on us and we can stay above a $500 area, that psychological area on the SPY or the S&P 500. That would be really nice. Look at this. So if you look, BAC, the Bank of America, this is one of these day trades when I look at, it's hard for me not to take. 1, 2, 3, 4, and now we're coming up that fifth time right here at this VWAP area. If it's showing an area of resistance and it failed once, maybe we pop back up and we find resistance right here again at that VWAP area. This might be a nice area to take a short, but it is a slower mover. This isn't one that I'm very interested in to taking a short. And like I said, we're usually going to move sideways most of the time during these FOMC meetings. So we have plenty of other banks that we can look at. We got utilities we can look at. We can bring up some utilities here. So utilities ETF is XLU. You can see it is on the rise. This is nice. We've been talking about it coming up here, being on a rise, maybe finding something that we could take for a mover. We have CEG here, which is a faster mover at 3.9. We have plenty of other ones here, but they're not as fast, like DUK. DUK is popping up. That's looking pretty good. SO, GWR, oh, yuck, that one's gross. I don't feel like running through utilities. I'm not too happy about utilities, guys. When it comes to utilities, you got to understand. People go into utilities when the market's not doing so hot, but you're not going to get rich trading utilities. Look at the S&P 500 now, guys. Back up there, like we said, if it breaks this area, we might come back up, but it's still going to stay within this range normally. Same thing with the QQQs. If the S&P 500 went up, look at this. QQQ went right back up into here. Stopped me out for a very, very small loss. I like that. $6.95. That's A-okay when you're holding a nice big trade over here, a nice juicy 213 on the day for EGY, and we've already traded NVIDIA. We made $159 on NVIDIA as well, which NVIDIA, wow, this would have been a beautiful short to hold on this whole thing. I just made a small piece right here and a small piece right here. So we gave a little bit back on NVIDIA, but we're holding on to most of our games. 159 on NVIDIA, and we made on EGY, we made 213, so we're up roughly $325. Did I say that right? 300, well, almost 400. Yeah, almost $400. So 159 and 370. We'll just say 370. How about that? That way nobody thinks that I'm trying to over-exaggerate here. No point in over-exaggerating. 370 is enough money. I'm pretty happy with it. But I am really telling you, this Netflix trade, if this thing just breaks down here and rips past all of this, I think Netflix has a good chance of really, really caving in. So let's definitely keep that in mind. Whoops, here we go. Yeah, so we do have the Federal Reserve on standby. Yeah, standby Federal Reserve. I'm doing my piece right now. Maybe in a little bit. Go ahead, stand by there. But we got them on standby, so that way when the time comes, we know to let them talk, let them do their thing. That's going to be coming out very, very soon here, guys. We got about 20 minutes. Less than 20 minutes now until the rate hike decision comes out. That's going to be an absolutely beautiful thing, guys. That Fed rate hike decision, I'm telling you, regardless, even though in May we are to stay, I think that Fed rate hike decision is still going to be a huge mover. It's going to be very volatile, in my opinion. So we'll see very, very soon if it is. Now, what did I bring this up here for? Okay, so that's the financial sector, the S&P 500. Did we already come all the way back down? Where are we at? Let's get the Smith indicators off here so I can see a little bit better. And let's zoom in on the 1 minute so that way we can see where we're at. So we're at 582. So we're coming back down pretty quick here on the S&P 500. As for the QQQs, it looks like it's doing the exact same, kind of flushing back down here. Let's go ahead and take a little peeky gander. Let's go back over to my Thinkorswim charts. And yes, that's exactly what happened, guys. That's what I mean. We're just staying range bound here, guys. You got your top up here at 501.83 and your lows at 499.93. It's just not looking that pretty. But that's what usually happens. People aren't going to get too one-sided until the data comes out, and then that's the whole reason why you want to know what's going on, because if you're out here trying to trade all this big money, and you're like, why can't I make money on this? Why is this just trading back and forth, back and forth, back and forth, and you can't make any money? Well, there's a big reason for that. It's because there's data coming out that you're not aware of. That's a scary thing. That's why we need to make sure that we're always staying vigilant. You always know when that data is to come out, when you think that data, you can even have a bias if you want to, but wait until after that data comes out in order to really make a trade. Let that data come out, let it cool down. If the data makes it pop up into a key area that you're willing to take a trade on, whether it's breaking a key area of support or running into an area of resistance, those would be a better places to trade. Okay, so the S&P 500 still above that $500, that very psychological $500 area. We're going to see what it wants to do, as the QQQ is sitting at 421.78 right now. The IWM, wow, nice little push there, came right up, but staying within that range. It's trading at 195.91. Its last push got us up to 196.20. The NASDAQ just trading sideways, just like the other indices. SMH bounce back up here into VWAP. It's just kind of trading sideways as well. The RSP is now showing at least a little bit of faith that we have some breath in the market. Predator, I don't know when you put this, but going out on a limb to see if I'm charting correctly. S&P seems to be riding a decent triangle heading back to the 494 area, support area. So first of all, which time frame are you on, Predator? That's very, very important. Yes, and it is all dependent on Powell's update. Absolutely. But yeah, I know you're trying to learn how to do the trends and all that good stuff, and I really appreciate it. Yes, you can look at this where I don't know when you actually wrote that, so I'm sorry I wasn't up to date on it, but we were moving back up to the trend. I would have took in this as an area of resistance, not only in the trend, but an area of resistance because of this this VWAP area. It actually broke up above it, made kind of a double top here, and this is on the 1 minute, you know. But if we would look at the daily, you know, we're going to see something totally different, totally different here. You can see something like this being a channel here like this. Here's a channel, and you can see another channel here like this. And we can see that we've broken that channel, you know. So there's a lot of different ways to look at it. I think it all depends on, first of all, what time frame you're on, and second of all, what you know, where you're at, how you like to chart. Okay. So guys, we got about 15 minutes till that Fed rate hike decision comes out. I promise you, it's going to be volatile no matter what. NFLIX. Let's see what it's doing here. NFLIX is wanting to push higher here, guys. That's nice. It's trying to break these highs. It's trying to move a little bit higher here. That'd be nice to see NFLIX continue higher. Wanting to rip, tater chip. Let's see if it can do it there. I am still bearish on Netflix if it breaks this area. If it wants to continue higher, I'm not going to argue. I like the Netflix. I'll just sit here and chill while Netflix does its thing. S&P 500 looks like it's bouncing up. So maybe breaking this trend, coming back, retesting this area might show that it's got a little bit of wings. Maybe we can carry on. But like I said, guys, regardless, until old Papa Powell comes out, this whole day can be erased in one bar, one stinking bar. So that's what we're waiting for. You know, if you're taking little baby trades here or there just to keep yourself entertained, I don't, you know, I shouldn't say I don't recommend that. Okay, I definitely don't recommend that. That's not the best thing to do. Let's go over some of these high tight flags. VITL, my alert went off on that yesterday. We're at an area of resistance right there. I'm just going to mark my chart so that way when it comes back up to this area, we can see if it wants to take off. Following that 10-day moving average, we have AVDL. It broke its trend yesterday. This thing wants to continue higher. It can. And we got to be careful of those earnings that are coming out on the 8th. We have AGTI. That one looks yuck. CENX looks like it's breaking down. MAG's just kind of trading right up there right at that 10-day moving average. INSP. So this is decent, interesting looking one. It is looking like it's starting to get pretty tight here. I'm just going to set my alert. I don't like the volume that's on it. It's not much there. GATO, AEM. Speaking of AEM, I want to look at ANF. Let's see where that's at right now. So it's got a nice little pop back up to it after a big sell-off. Yesterday I was hoping this thing would get back up into this area so I could take a sell-off. I made a little bit of money on the short side, but I did not want to hold out overnight, which obviously is posing to be a silly thing to do. We'll see what it wants to do here. Let's, you know what I do want to take a look at is XOM, and let's see, it's still trading lower. Let's look at EGY then. That should be trading lower as well. Yeah, we're just kind of stagnant. We're up about $222 on this trade. I'm just holding out. You know, when it comes to this FOMC meeting, I don't think this is going to be affected too very much by the FOMC meeting. But what I will do, guys, excuse me, I'm going to set my stop loss right here. I don't really need to set a stop loss on this just because it's such a slower mover. It does move 3.5%. What I am worried about setting a stop loss in the FOMC meeting is that not only if it pops back up, that it's just going to rip right back down, and then it'll just be stop loss hunting. So I'll just keep a close eye on it. Actually, better yet, what I will do is I'm going to set an alert here, so that way if it does get back up in that area, I'm at least aware of it, so we're not being silly there. Let's take a look at gold. So gold barracks, again, very bearish. I've been very bearish on gold lately, guys, just because of everything that I've been hearing, all the questions that I've been getting asked about gold. I would love to see gold go higher. If you got a gold position, I'm sorry, I'm just calling it how I see it. Let's see, do we have earnings? We did have some earnings come out today. I don't know, that could be the best case scenario or worst case scenario if you're coming out on a Fed rate hike decision. I know if I owned a business, I definitely wouldn't want to be having my Fed rate hike decision on the same day I had earnings. So we got a couple of these. I'm just going to run through them really quick, and then we're going to go back over the major indices. Universal stainless. That's a nice push right there. CRS, wow. CRS, Carpenter's Technology, amazing. Oh, remind me when we go live for that Powell talk. Remind me to turn off that lo-fi trader music. Lo-fi trader. The OGs remember lo-fi. The OGs remember lo-fi trader, baby. All right, let's go back over them, guys. S&P 500 just range trading. We're just here. Another 10 more minutes, guys. 10 more minutes. The data's going to get dropped. It's going to get dropped. You're going to hear it first. You're going to hear it first. You're going to hear it now. You're going to hear the data from a couple different places. But all we want to know is, what is the Fed rate hike decision? May, we are to stay. We can go back over that really quick. The CME group, you can check this out, cmegroup.com. It's absolutely free to use this. This is where I get most of my data for the future of what is going to happen. In May, we have a 98.9% chance that we are to stay at 5.5%. If it comes out any different, you're going to see this market go yeet skeetily do. This thing is going to freak out on you. I don't know. To the north side, if we get a Fed rate cut, but we have a 0% chance of that happening. So if we get a Fed rate hike at 1.1%, very less likely to do that. But if it does happen, I can promise you this market is going to crap itself. Colonoscopy City, grab the diapers and some wipes. It's going to be very, very messy if that happens. Because remember, Powell's whole reason for his existence in the Fed is simply this: to keep jobs created and to keep interest rates, inflation, sorry, not interest rates, but the inflation at 2%. If he can keep it at 2%, he will be a happy, happy man. We want to make sure that we can get that down to 2% and sustain it at 2%. If we can't do that, then he's not doing his job in his mind, and he is going to keep those Fed rate at 5.5% longer. If we can't lower those interest rates, then everything is going to continue to be harder to borrow money. That means rent will be high because it's going to cost people more to borrow from the bank to buy those houses. And in order for a but for someone who buys these properties, okay, investment property businessmen, what they do is they pull a loan from a bank and then they buy the property, and then they get a renter to go inside this property and live, and then they charge the rent for whatever it costs for them to not just cover the house, but for them to make money too. So if they have to pay 6.5% to borrow a loan for a $100,000 home, they're going to put that on the person who's renting. That's why rent's so high right now. That's why businesses are struggling right now, because it's hard for them to continue to pay the money that they've borrowed for their either rent or for their buildings or for any of that stuff. Okay, so when the Fed keeps interest rates up, it makes everybody's spending come down. With less spending comes less demand. With less demand comes more supply. With more supply comes lower inflation. Okay, that is a easy way to think about it. If there's not a lot of spending and we're using monetary policy to keep those interest rates up, then people are not going to be able to spend as much money. Okay. One crazy thing about all this, though, is even though the Fed has kept this interest rate for quite some time at 5.5%, we still are seeing jobs. We are still seeing plenty of jobs. Not a lot of people are unemployed right now. Not a lot of people are looking for those for unemployment benefits. Okay, so it's a very interesting time to be in right now. Okay, so if you guys haven't already, make sure you hit that live button. Go ahead and look at my screen really quick, guys. If you hit this live button, you know, if you're back here and you don't know what's going on, there's a live button right here. You click that live button, it'll bring you live. We want you to be live because in 6 minutes, those Fed interest rates come out. We want you to make sure that you're live. Also, smash this like button for me. We know we got a couple of you in here. I want to make sure we get those likes up. We got 6 people watching, 7 likes. I don't know how that happened. We also have votes. We got 10 of you that voted on here. I appreciate that. Hit that subscribe button if you haven't already. We are here every single day bringing you bite-sized data. Since you don't need to know or understand the data, we learn and understand it for you. We put it up in an easy way to understand. We say, stock go up, stock go down if data says this, okay? We ingest that data, we bring it to you so you can better understand it, and then we keep on keeping on, as my grandma always loved to say. So guys, we are having those Fed interest rate come out in 5 minutes. I'm gonna be right here. I'm gonna whip it out for you. Whip, whip, baby, whip, whip. We're gonna bring that, and then after that, we'll be chatting with you for just a little bit. But basically, we're gonna let this stream go. I might take a quick break and hang out with my boy, but Papa Powell is going to take over my channel. He's going to say, hey, you know, I got something to say, and I'm going to let him say it. I'm going to go ahead and let him say it. I'm going to let him take the mic. I'm going to say, Papa Powell, here's the mic. Please don't drop it. We don't want to see the S&P 500 break, the S&P 500 break 500. You know, this is our line we want to hold. You know what I mean? Like here, we'll just go ahead. We'll go to the S&P 500. Okay, and this is the line we want to hold right here, right here. We can even throw a couple of stickers on here. You know, we want it to rock it up right here. Boom. Okay, let's rock it up from here. Let's go to the north side, Papa Powell. Let's not go down, because if we go down, it's gonna be a sad day. You know, it's gonna be a sad day right here. It's gonna be sad if we break down. All right, so we'll see what old Papa Powell wants to do. It's either going to be rockets or tears, you know. We definitely want for everybody's the Roth IRAs, the 401ks, your long-term investment strategies, your vehicles to make more money for your retirement, for your generational wealth, for your future, for your kids. We want to see that continually going up. Obviously, can't always go straight up, but this we would like to see as a correction. See this right here? We would like to call this a correction, not a bear market or a recession. A correction is better than a recession. A recession would be very, very bad. Now, guys, we got 3 minutes. I'm starting to get excited here. Let me get a drink. 3 more minutes. That data is going to come out hot, hot heat, baby. If you can't handle the heat in the kitchen, then stay out. So I appreciate you guys being here. And then right after that, we got the FOMC press conference. Papa Powell's going to come out and he's going to say, yeet skeetily doo, baby. You guys are going to be rich or you guys are going to be poor, and I don't care. He might not say those exact words, but I'm sure it'll be close to somewhere around there. Let's take a look back at Netflix. Yeah, Netflix, nice little push here. It's a nice little push off that base. Yeah, right here off this base, right before it wanted to break down. It made new higher lows on the daily and wants to head on higher. If we look at the hourly though, we can see we got this downtrend. So maybe this is a nice pop, one more pop, maybe back up to 558 before it heads lower. Let's just draw this trend here so we can see it on the hourly, okay? So it's kind of looking like that. It's not looking entirely too good, you know? So this pop might be, yeah, look at that, you know? We took it from the top, brought it off this, and now it's right into there. You know, it's not looking like the best thing here. And with interest rates coming out in 2 more minutes, we're really going to see what things want to do here. Let's take a look at the one trade that I have put on EGY. It looks like we're up about $250 on this trade now. So we're up probably about a total of $400 roughly for the day, I think. Yeah, we're a little over, let's look at NVIDIA. 160 EGY, we're up 250. Yeah, so we're up a little over $400 for the day. So that's nice. I mean, my goal is 500 for the day, but 400 for the day, I'm not going to be complaining. But we're still early in the day, so we're going to see what all is going to happen with this. Maybe we continue lower. But old Papa Powell's coming out in about 30 minutes. But right now, we need to switch back to the S&P 500. You know why. You know exactly why, ladies and gentlemen. We have those Fed interest rates coming out. So I'm going to stay alert, attentive, and focused, because this is when the beat drops. Hi, beautiful. That's the wife. I wasn't talking to myself, guys. I swear. All right, we got the news up. We got the stonks up. We're going to see what happens here, guys. Here we go. Here we go. This is me rubbing my hands together. What's going to happen? What's going to happen? I'm so excited. We're expecting that 5.5% to come out, and will we get that 5.5% to come out? If it doesn't, if we come out, oh, look at that. We're starting to get some volatility. Where is the news? That's what we want, baby. We're starting to get volatility. People are already getting excited. 2 o'clock just hit. Now we should be getting that release, and boom, we got 5.5%. So we did get the expected 5.5% on the Fed rate hikes decision. So that should tell us exactly in this overall market what we need to happen. And that is it, ladies and gentlemen. 5.5%. We got a big pop and a drop. So let's see what the overall market wants to do. And like I said, we aren't expecting anything too crazy. We know it's going to get volatile, but we don't want to see anything too crazy. Why? Well, because we are expecting 5.5%. If 5.5% comes out just like everybody's expecting it, the market does a great job of pricing this in. So let's see. Are we going to get a pop and then another drop? Well, Powell comes out in about 30 more minutes. So we will be back then to let him talk. So I'm going to have this Federal Reserve up. When that happens, I will be right back on. I think what I'll do is I'll leave the S&P 500. I don't mean to leave dead air, but we want to make sure that we leave this up for everybody to see what's going to happen. My son is up. It is my turn to keep a close eye on him. And yeah, we got a big pop. Maybe we get a drop now after that. But I don't think anything too crazy is going to happen. Look at NFLIX breaking up above that trend that we just drew. That is a beautiful thing. Maybe we take a long here, ladies and gentlemen. Who knows? Who knows? QQQ popped up, cleared those highs. Doesn't look like it wants to do much. NVIDIA, nice pop right into that anchored V or that VWAP area. Let's take a look at V because I knew I wanted to see a pop off there. We're getting a nice little move up there. MSoft, let's see how that's doing. Nice little pop as well. Let's look at the SPY again. Okay, so SPY is just getting a little wonky. It's still range bound, guys. Range bound before a Powell comes out. So what I'm going to go ahead and do here is I think I'm going to mute this mic. Okay, I'm going to mute this mic. And we're going to let the S&P 500 do its thing. And I'm going to take a break. We will be back in 30 minutes for old Powell to come out and chat with us on what is going to go on in this overall market. So what I'm going to do is I'll bring this up here so everybody knows that this is exactly what we're going to be doing today. All right. So we just know. We got to know, baby. If you don't know, then you'll never find out. And we'll get rid of this. We'll get rid of me. Bye-bye. Goodbye. Auf Wiedersehen. And I will be back on to give you guys a bit of a rundown a little later. And we will make sure that we keep a close eye on this beautiful press conference. Give me one sec.
For the system, including 12 Federal Reserve banks located around the country, which take the pulse of the nation's economic health from a regional perspective. The 12 reserve banks represent different geographic regions, or districts, and were set up based on regional economic considerations. Although supervised by the Federal Reserve Board, the reserve banks operate independently in many respects. The reserve banks carry out a number of core system functions, such as supervising and examining commercial banks and other financial institutions, enforcing compliance with federal consumer protection and fair lending laws, while promoting local community development and lending to depository institutions to ensure crucial liquidity in the financial system. They and the board also play a key role in another primary Fed function, fostering the safety and efficiency of our nation's payment systems, including distributing currency and coin to banks, operating electronic payment systems, and clearing our checks. In addition, the reserve banks act as the government's bank, providing services such as maintaining the Treasury Department's transaction account and issuing and redeeming U.S. government securities. They also act as a bank for banks by providing key financial services to banks, thrifts, and credit unions. The reserve banks also provide a wealth of information on conditions across the nation, information that is vital to formulating a national monetary policy that helps maintain a healthy U.S. economy and a stable financial system. The board and the reserve banks together help ensure that consumer and community voices are heard at the central bank through consumer-focused outreach, research, and analysis. This helps keep the Federal Reserve's actions, policies, and decision-making attuned to what's going on in American households, communities, and businesses, which are the foundation of our economy. The third key Fed entity is the Federal Open Market Committee, or FOMC, which brings together representatives from the board and the reserve banks to consider the state of the U.S. economy and set a course for our monetary policy in a manner that seeks to promote an economy that works for all Americans. The 12-member FOMC establishes an appropriate position or stance for monetary policy to help move the economy towards two essential mandates set for the Fed by Congress, promoting maximum employment and price stability. This occurs mainly through the FOMC's influence on interest rates and credit conditions, which can significantly impact financial conditions, including economic productivity and even spending and investment decisions by households, communities, and businesses. Working together, these three key Fed entities and the unique Federal Reserve System structure established by Congress more than a century ago help promote conditions resulting in a strong, healthy, and sustainable economy. For more information on how the Fed functions, visit federalreserve.gov and click on About the Fed.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. The economy has made considerable progress toward our dual mandate objectives. Inflation has eased substantially over the past year, while the labor market has remained strong. And that's very good news. But inflation is still too high. Further progress in bringing it down is not assured, and the path forward is uncertain. We are fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustainably strong labor market that benefits all. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings, though at a slower pace. Our restrictive stance of monetary policy has been putting downward pressure on economic activity and inflation, and the risks to achieving our employment and inflation goals have moved toward better balance over the past year. However, in recent months, inflation has shown a lack of further progress toward our 2% objective, and we remain highly attentive to inflation risks. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. Although GDP growth moderated from 3.4% in the fourth quarter of last year to 1.6% in the first quarter, private domestic final purchases, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal on underlying demand, was 3.1% in the first quarter, as strong as the second half of 2023. Consumer spending has been robust over the past several quarters, even as high interest rates have weighed on housing and equipment investment. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. The labor market remains relatively tight, but supply and demand conditions have come into better balance. Payroll job gains averaged 276,000 jobs per month in the first quarter, while the unemployment rate remains low at 3.8%. Strong job creation over the past year has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a continued strong pace of immigration. Nominal wage growth has eased over the past year and the jobs-to-workers gap has narrowed, but labor demand still exceeds the supply of available workers. Inflation has eased notably over the past year, but remains above our longer-run goal of 2%. Total PCE prices rose 2.7% over the 12 months ending in March. Excluding the volatile food and energy categories, core PCE prices rose 2.8%. The inflation data received so far this year have been higher than expected. Although some measures of short-term inflation expectations have increased in recent months, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are strongly committed to returning inflation to our 2% objective. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings, though at a slower pace. Over the past year, as labor market tightness has eased and inflation has declined, the risks to achieving our employment and inflation goals have moved toward better balance. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We've stated that we do not expect that it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. So far this year, the data have not given us that greater confidence. In particular, and as I noted earlier, readings on inflation have come in above expectations. it is likely that gaining such greater confidence will take longer than previously expected. We are prepared to maintain the current target range for the federal funds rate for as long as appropriate. We're also prepared to respond to an unexpected weakening in the labor market. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we've seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. We will continue to make decisions meeting by meeting. Turning to our balance sheet, the committee decided at today's meeting to slow the pace of decline in our securities holdings, consistent with the plans we released previously. Specifically, the cap on Treasury redemptions will be lowered from the current $60 billion per month to $25 billion per month as of June 1. Consistent with the committee's intention to hold primarily Treasury securities in the longer run, we're leaving the cap on agency securities unchanged per month, and we will reinvest any proceeds in excess of this cap in Treasury securities. With principal payments on agency securities currently running at about $15 billion per month, total portfolio runoff will amount to roughly $40 billion per month. The decision to slow the pace of runoff does not mean that our balance sheet will ultimately shrink by less than it would otherwise, but rather allows us to approach its ultimate level more gradually. In particular, slowing the pace of runoff will help ensure a smooth transition, reducing the possibility that money markets experience stress and thereby facilitating the ongoing decline in our securities holdings that are consistent with reaching the appropriate level of ample reserves. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you. Howard Schneider with Reuters. A question to follow up, if I could. Do you consider the current policy rate still, are you confident that it's sufficiently restrictive to get inflation back to 2%?
So I do think the evidence shows, pretty clearly that policy is restrictive and is weighing on demand. And there are a few places I would point to for that. You can start with the labor market. So demand is still strong, the demand side of the labor market in particular. But it's cooled from its extremely high level of a couple of years ago. And you see that in job openings. You saw it, more evidence of that today in the JOLTS report, as you'll know. It's still higher than pre-pandemic, but it has been coming down both in the Indeed report and in the JOLTS report. That's demand cooling. The same is true of quits and hiring rates, which have essentially normalized. I also we look at surveys of workers and, surveys of workers and businesses and ask workers, are jobs plentiful, and ask businesses, are workers plentiful? Is it easy to find workers? And you've seen that the answers to those have come back down to pre-pandemic levels. You also see in interest-sensitive spending like housing and investment, you also see that higher interest rates are weighing on those activities. So I do think it's clear that that policy is restrictive.
Sufficiently restrictive, I guess.
So I would say that we believe it is restrictive, and we believe over time it will be sufficiently restrictive. That will be a question that that the data will have to answer.
So as a follow-up, if inflation continues running roughly sideways as it has been, the job market stays reasonably strong, unemployment low, and expectations are anchored and maintained, would you disrupt that for...
Expectations are not anchored.
Or anchored.
Or anchored.
Stable, roughly. Would you disrupt that for the last half point on PCE?
I don't want to get into complicated hypotheticals, but I would say that, we're committed to retaining our current restrictive stance of policy for as long as is appropriate, and we'll do that.
Gina. Thanks for taking our questions, Chair Powell. I wonder, obviously Michelle Bowman has been saying that there is a risk that rates may need to increase further, although it's not her baseline outlook. I wonder if you see that as a risk as well, and if so, what change in conditions would merit considering raising rates at this point?
So I think it's unlikely that the next policy rate move will be a hike. I'd say it's unlikely. Our policy focus is really what I just mentioned, which is how long to keep policy restrictive. You ask, what would it take? I think we'd need to see persuasive evidence that our policy stance is not sufficiently restrictive to bring inflation sustainably down to 2% over time. That's not what we think we're seeing, as I mentioned. But that's something like that is what it would take. We'd look at the totality of the data, answer to that question. That would include inflation expectations, and all the other data too.
Would that be like an acceleration in inflation?
Well, I think, again, the test, what I'm saying is if we were to come to that conclusion that policy weren't tight enough to achieve that, so it would be the totality of all the things we'd be looking at. It could be expectations, it could be a combination of things, but if we reach that conclusion and we don't see evidence supporting that conclusion, that's what it would take, I think, for us to take that step.
Chris.
Thank you, Chris Rugaber at Associated Press. You didn't mention the idea that rates are at a peak for the cycle, and didn't mention the idea that it might be appropriate to cut rates later this year, as you have at previous press conferences. So has the Fed sort of dropped its easing bias? Where are you standing on that?
So let me address cuts. So obviously, our decisions that we make on our policy rate are going to depend on the incoming data, how the outlook is evolving, and the balance of risks, as always. And we'll look at the totality of the data. So I think, and we think, that policy is well positioned to address different paths that the economy might take. And we've said that we don't think it would be appropriate to dial back our restrictive policy stance until we've gained greater confidence that inflation is moving down sustainably toward 2%. So, for example, let me take a path. If we did have a path where inflation proves more persistent than expected and where the labor market remains strong, but inflation is moving sideways and we're not gaining greater confidence, well, that would be a case in which it could be appropriate to hold off on rate cuts. I think there's also other paths that the economy could take which would cause us to want to consider rate cuts, and those would be, two of those paths would be that we do gain greater confidence, as we've said, if that inflation is moving sustainably down to 2%, and another path could be, an unexpected weakening in the labor market, for example. So those are paths in which you could see us cutting rates. So I think it really will depend on the data. In terms of peak rate, I think really it's the same question. I think the data will have to answer that question for us.
Well, and could you just follow on the path where you might not cut? Is that, you mentioned that it would be inflation persistent. Is inflation, would that be the key data in making that decision, or could you expand a bit more on that? Thank you.
Again, we've set ourselves a test that for us to begin to reduce policy restriction, we'd want to be confident that inflation is moving sustainably down to 2%. And for sure, one of the things we'd be looking at is the performance of inflation. We'd also be looking at inflation expectations. We'd be looking at the whole story, but clearly incoming inflation data would be at the very heart of that decision.
Nick Timrose of the Wall Street Journal. Chair Powell, to what extent has the easing in financial conditions since November contributed to the reacceleration in growth? And do you now expect a period of sustained tighter financial conditions will be needed to resume the sort of disinflation the economy saw last year?
So I think it's hard to know that. I think we'll be able to look back, from down the road and look back and understand it better. If you look at, let's look at growth. Really, what we've seen so far this year in the first quarter is growth coming in about consistent with where it was last year. I know GDP came in lower, but you don't see an acceleration in growth. I mean, the thought would be that financial conditions loosened in December, and that caused an uptick in activity, and that caused inflation. Presumably that's what, or tightening in the labor market. You don't really see that happening. What you see is economic activity at a level that's roughly the same as last year. So, what's causing this inflation, we'll have a better sense of that over time. I don't know that there's an obvious connection there, though, with the easing of financial conditions. In terms of tightening, you're right. I mean, rates are certainly higher now and have been for some time than they were before the December meeting, and they're higher, and that's tighter financial conditions, and that's appropriate given what inflation has done in the first quarter.
You've said in the past that stronger growth wouldn't necessarily preclude rate cuts. I wonder, would continued strength in the labor market change your view about the appropriate stance of policy if it was accompanied by signs that wage growth was reaccelerating?
So I just want to be careful that we don't target wage growth with the labor market. And remember what we saw last year: very strong growth, a really tight labor market, and a historically fast decline in inflation. So and that's because we know there are two forces at work here. There's the unwinding of the pandemic-related supply side distortions and demand side distortions, and there's also monetary policy, restrictive monetary policy. So I wouldn't rule out that something like that can't continue. I wouldn't give up at this point on further things happening on the supply side, either because we do see that companies still report that there are supply side issues that they're facing, and also even when the supply side issues are solved, it should take some time for that to affect economic activity and ultimately inflation. So there are still those things. So I don't like to say that either strong either growth or a strong labor market in and of itself would automatically create problems on inflation, because of course it didn't do that last year. You ask about wages. We also don't target wages. We target price inflation. It is one of the inputs. The point with wages is, of course, we like everyone else like to see high wages, but we also want to see them not eaten up by high inflation. And that's really what we're trying to do, is to cool the economy and work with what's happening on the supply side to bring the economy back to 2% inflation. And part of that will probably be having wage increases move down incrementally toward levels that are more sustainable.
Rachel. Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. You talked about needing time to gain more confidence that inflation is sustainably moving back down to 2%. It's May now. Do you have time this year to cut 3 times, just given the calendar?
Yeah, I'm not really thinking of it that way. What we've said is that we need to be more confident, and we've said, my colleagues and I today said, that we didn't see progress in the first quarter, and I've said that it appears then that it's going to take longer for us to reach that point of confidence. So I don't know how long it'll take. I can just say that when we get that confidence, then rate cuts will be in scope, and I don't know exactly when that will be.
And with hindsight, are there any signs that you can look back on now, looking at the reports from January or February or March, that suggested something more worrying than just expected bumpiness? Not really. So I thought it was appropriate to reserve judgment until we had the full quarter's data, until we saw the March data. And so take a step back. What do we now see in the first quarter? We see strong economic activity. We see a strong labor market, and we see inflation. We see 3 inflation readings. So I think you're at a point there where you should take some signal. We don't like to react to 1 or 2 months' data, but this is a full quarter, and I think it's appropriate to take signal now, and we are taking signal. And the signal that we're taking is that it's likely to take longer for us to gain confidence that we are on a sustainable path down to 2% inflation. That's the signal that we're taking.
Yeah, Mr. Chair, if I could, Steve Leisman, CNBC, if I could follow up on that. What particular areas were sort of temporary or blips in the inflation data in the first quarter? And what's the dynamic by which you expect them to work out in the coming months and quarters?
Yeah. So we will, we will put the thing under a microscope. I will say nothing is going to come out of that that's going to change the view. I think that, in fact, we didn't gain confidence, and that it's going to take longer to get that confidence. But confidence, I just think, I mean, you know the story. What's happened since December is you've seen higher goods inflation than expected, and you've seen higher non-housing services inflation than expected, and those two are working together to sort of be higher than we had thought. And there are stories behind how that happened. And you know, I think my expectation is that we will, over the course of this year, see inflation move back down. That's my forecast. I think my confidence in that is lower than it was because of the data that we've seen. So we're looking at those things. We also continue to expect, and I continue to expect, that housing services inflation, given where market rents are, those will show up in measured housing services inflation over time. We believe that it will. It looks like that there are substantial lags between when lower market rates turned up and for new tenants, and when it shows up for existing tenants or for in housing services. So,
if I could just follow up, is there a bit of a contradiction in the idea that you are reducing quantitative tightening, which is sort of an easing, while you're holding rates steady at a restrictive rate to try to slow and cool the economy and inflation? Thank you.
No, I wouldn't say that. No, I mean the active tool of monetary policy is, of course, interest rates, and this is a plan we've long had in place to slow, really not in order to provide accommodation to the economy, but to be less restrictive to the economy. It really is to ensure that the process of shrinking the balance sheet down to where we want to get it is a smooth one and doesn't wind up with financial market turmoil the way it did the last time we did this, and the only other time we've ever done this.
Forrest from Bloomberg. Two questions. First, simple one. Given the run of data since March, has the probability in your mind of no cuts this year increased or stayed the same? That's the first question. Second question. Chair Powell, you joined the board in 2012, and I'm sure you remember, as I do, what the jobless recovery was like. Lawyers, accountants, all kinds of highly qualified people who couldn't get jobs. And given your history there, I wonder if there's an argument for being more patient with inflation here. We have strong productivity growth that's helping wages go up. We have good employment. And so it seems to me there's a lot of hysteria about inflation. I agree, it's, nobody likes it, but is there an argument for being patient and working with the economic cycle to get it down over time? Thank you.
So on your first question, I don't have a probability estimate for you, but all I can say is that, we've said that we didn't think it'd be appropriate to cut until we were more confident that inflation was moving sustainably at 2%. Our confidence in that didn't increase in the first quarter, and in fact, what really happened was we came to the view that it will take longer to get that confidence. And I think I think it's the economy has been very hard for forecasters broadly to predict its path, but there are paths to not cutting, and there are paths to cutting. It's really going to depend on the data. In terms of the employment mandate, to your point, if you go back a couple of years, our sort of framework document says that when you look at the two mandate goals, and if one of them's further away from goal than the other, then you focus on that one. It actually it's the time to get back there times times how far it is from the goal, and that was clearly inflation. So our focus was very much on inflation, and this is what we referred to in the statement. As inflation has come down now to below 3% on a 12-month basis, it's become we're now focusing the other goal, the employment goal, now comes back in to focus, and so we are focusing on it, and that's how we think about that.
Claire Jones, Financial Times. Thanks a lot for the opportunity to ask the questions. Just to go back to the answer before the previous one, it seemed to suggest that you think the likeliest path of inflation is one that's going to allow you to have a situation where rates are lower at the end of the year than they are right now. It'd be good if you could just confirm whether or not that's a correct reading. And the Q1 GDP print has led to some to start mentioning the term stagflation with respect to the US economy. Do you or anyone else on the FOMC think this is now a risk? Thank you.
Yeah, I'm not dealing really in likelihoods. I think there are paths that the economy can take that would involve cuts, and there are paths that wouldn't. And I don't have great confidence in which of those paths. I would say my personal forecast is that we will begin to see further progress on inflation this year. I don't know that it will be sufficient. I don't know that it won't. I think we're going to have to let the data lead us on that. In terms of your question, your second question was stagflation. I guess I would say I was around for stagflation, and it was 10% unemployment. It was high single digits inflation. Right now we have and very slow growth. So right now we have 3% growth, which is pretty solid growth, I would say, by any measure, and we have inflation running under 3%. So I don't really understand where that's coming from. And in addition, I would say most forecasters, including our forecasting, was that last year's level of growth was very high, 3.4% in, I guess, the fourth quarter, and probably not going to be sustained and would come down. But that would be our forecast. That wouldn't be stagflation. That would still be to a very healthy level of growth. And of course, with inflation, we will return inflation to 2%, and that won't be. So I don't see the stag or the inflation, actually.
Michael McKee from Bloomberg Radio and Television. The vice chair of the FOMC said recently that he's willing to consider the idea that potential growth has moved up, and of course he's Mr. Potential Growth, our star. Do you share that view, and would that imply that maybe policy isn't tight enough?
I think I would take that question this way. We saw a year of very high productivity growth in 2023. And we saw a year of, I think, negative productivity growth in 2022. So I think it's hard to draw from the data. The question is, will productivity run? There are two questions. One is, will productivity run, persistently above its longer run trend? I don't think we know that. In terms of potential output, though, if that's a separate question. We've had what amounts to a significant increase in the potential output of the economy that's not about productivity. It was about having more labor, frankly, both through, in 2023, both through participation and also through immigration. So we're very much like other forecasters and economists getting our arms around what that means for potential output this year and next year and last year for that matter too. So I think in that case, I think you really do have a significant increase in potential output, but you've also got you've got more supply, but those people also come in, they work, they have jobs, they spend, so you've also got demand. So it may be that you get more supply than you get demand at the beginning, but ultimately it should be neither inflationary nor disinflationary over a longer period.
Well, you said earlier that at this point you're not really considering rate increases. If growth is higher, but you're not considering rate increases, does that imply that you're more worried about causing the economy to slow too much than you are about inflation taking off again?
No, I think we believe our policy stance is in a good place and is appropriate to the current situation. We believe it's restrictive, and our evidence for that I went over earlier. You see it in the labor market, you see it in inflation-sensitive spending, where demand has clearly come down a lot over the past few years, and that's more from monetary policy, whereas the supply side things that are happening are more on the supply side. So that's how I would think about it.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. So GDP growth is about 2%. Inflation, employment is about 4%. It feels a lot like a steady state, and we have 3% inflation. So if the data remains the same that you're seeing, and I know you said you don't see a rate hike, but it stands to reason that you would need a rate hike to get from 3 to 2% inflation. So was there any discussion about a rate hike in today's meeting? And, you know, are you satisfied with 3% inflation for the rest of the year?
Well, of course, we're not satisfied with 3% inflation. 3% can't be in a sentence with satisfied. So we will return inflation to 2% over time, but over time. And we think our policy stance is appropriate to do that. So if we were to conclude that policy is not sufficiently restrictive to bring inflation sustainably down to 2%, then that would be what it would take for us to want to increase rates. We don't see that. We don't see evidence for that. So that's where we are.
Was there a discussion about a rate hike at all?
So the policy focus has really been on what to do about holding the current level of restriction. That's part of the policy. That's where the policy discussion was in the meeting.
Yeah, I wanted to follow on the 3%. Is there a time frame of persistent inflation that would trigger a rate hike?
There isn't any rule. You can't look to a rule. You know, these are going to be judgment calls. Clearly, restrictive monetary policy needs more time to do its job. That is pretty clear based on what we're seeing. How long that will take and how patient we should be, it's going to depend on the totality of the data, how the outlook evolves.
Victoria. Hi, Victoria Guido with Politico. You've talked about your commitment to being apolitical and nonpartisan, and I was just wondering, given that it's an election year, is the bar for rate changes higher close to an election? And similarly, is there a significant economic difference between, you know, starting to cut in, say, September versus December?
So we're always going to do what we think the right thing for the economy is when we come to that consensus view that it's the right thing to do for the economy. That's our record. That's what we do. We're not looking at anything else. You know, it's hard enough to get the economics right here. These are difficult things, and if we were to take on a whole other set of factors and use that as a new filter, it would reduce the likelihood we'd actually get the economics right. So that's how we think about it around here. And, you know, we're at peace over it. We know that we'll do what we think is the right thing when we think it's the right thing, and we'll all do that. And that's how everybody around here thinks. So I can't say it enough that we just don't go down that road. If you go down that road, where do you stop? And we're not on that road. We're on the road where we're serving all the American people and making our decisions based on the data and how those data affect the outlook and the balance of risks.
And then is there a significant difference between, whether you start in, say, September versus December? And
there's a significant difference between an institution that takes into account all sorts of political events and one that doesn't. That's where the significant difference is. And you know, we just don't do that. I mean, you can go back and read the transcripts for this is my fourth presidential election here. Read all the transcripts and see if anybody mentions in any way the pending election. It just isn't part of our thinking. It's not what we're hired to do. If we start down that road, I don't know how you stop. So.
Thank you, Chair Powell. Question about the labor market. You've mentioned a few times that the labor market is normalizing. Certainly today's JOLTS data suggested that things are kind of getting back to pre-pandemic levels. One thing that hasn't normalized is wage growth, which is still quite a bit stronger than before the pandemic. I wonder if you can share your analysis of why that's happening. Is it a lagging indicator or something else going on?
So I think if you go back to where wages peaked, wage increases peaked a couple, 3 years ago, essentially all wage measures have come down substantially to that. But they are not down to where they were before the pandemic. They're still roughly a percentage point higher. And we've seen pretty consistent progress, but not uniformly. And you'll note the ECI reading from Tuesday was expected to have come down, and essentially it was flat year over year, I think, roughly. So, yeah, I mean, that part of it is bumpy.
And again, we don't target wage increases, but it, in the longer run, if you have wage increases running higher than productivity would warrant, and then there will be inflationary pressures. Employers will raise prices over time if that's the case. So we've seen progress. It has been inconsistent, but we have seen a substantial decline overall. But we have ways to go on that.
Scott. Nancy. Sorry. Hey, Chair Powell, Nancy Marshall-Genzer from Marketplace. You mentioned consumers, and consumers are feeling the weight of interest rates right now. Mortgage rates are up, as are rates for car loans, credit cards. People looking to borrow are very discouraged. That's reflected in their views on the economy. What would you say to them?
Well, the thing that hurts everybody, and particularly people in the lower income brackets, is inflation. If you're a person who's living paycheck to paycheck, and suddenly all the things you buy, the fundamentals of life, go up in price, you are in trouble right away. And so with those people in mind in particular, what we're doing is we're using our tools to bring down inflation. It will take some time, but we will succeed, and we will bring inflation back down to 2%, and then people won't have to worry about it again. That's what we're doing, and we know that it's painful and inconvenient, but the dividends will be paid will be very large, and everyone will share in those dividends. And we've made quite a lot of progress if you can think about it. I think headline core PCE peaked at 5.8. Now it's at, anyway, headline peaked at 7.1. Now it's at 2.7. Don't want to get that wrong.
No, you don't. Quick follow-up. Are current interest rates really doing that much, though, to fight inflation right now for those consumers?
Yes, I mean, I think that restrictive monetary policy is doing what it's supposed to do, and it's also in this case unusually working alongside and with the healing of the supply side. That was different this time was that a big part of the source of the inflation and the reason why we're having this conversation is that we had this supply side kind of collapse with shortages and bottlenecks and all that kind of thing. And so this was to do with the shutting down and reopening of the economy and other things that really raised demand. So many factors did that. So I think now you see those two things working together, the reversal of those supply and demand distortions from the pandemic and the response to it, along with restrictive monetary policy. Those two things are working to bring down inflation, and we've made a lot of progress. Let's remember how far we've come. And we have a ways to go. We've got work left to do, but we're not looking at the very high inflation rates that we were seeing 2 years ago.
Courtney Brown from Axios. Thanks for taking our questions, Chair Powell. I wanted to follow up on something you mentioned earlier on housing inflation. There's kind of been this long-awaited disinflation in shelter that still hasn't arrived. So I guess two questions. How do you explain the substantial lags between some of the private sector data we're seeing and the government data? And how confident are you that rents will be helpful on the inflation front in the coming months?
So essentially, there are a number of places in the economy where there are just lag structures built into the inflation process, and housing is one of them. So when you have when someone a new person goes to rent an apartment, that's called market rent, and you can see market rents are barely going up at all. The inflation in those has been very low. But it takes, before that, they were incredibly high. They sort of led the high part. So what happens is those market rents take years, actually, to get all the way into rents for tenants who are rolling over their leases. Landlords don't tend to charge as much of an increase to a rollover tenant for whatever reason. And what that does is it builds up a sort of an unrealized portion of increases when there have been big increases. And what happens is, it's complicated, but the story is it just takes some time for that to get in. Now, I am confident that as long as market rents remain low, this is going to show up in measured inflation. assuming that market rents do remain low. What will be the exact timing of it? I think we've learned that the lags are longer. We now think significantly longer than we thought at the beginning. And so confident that it will come, but not so confident in the timing of it. But yes, I expect that this will happen.
Thanks.
Thank you, Chair Powell, for taking the questions. This is Nicholas Jasinski from Barron's Magazine. It seems that over the past 3 or 4 years, economies and central banks in developed markets at least have been on more or less the same trajectory. Easing during the pandemic, fighting inflation with restrictive policy on the way out. Feels like that may be ending in 2024 based on some of the economic data from Europe and the US and Japan and statements from those central banks as well. So my question is, what considerations or risks does a period of more divergent global economic trajectories and central bank policies present for the FOMC?
So that you're right. I think that may happen, and you know that we all serve domestic mandates, right? So I think the difference between the United States and other countries that are now considering rate cuts is that they're just not having the kind of growth we're having. They have their inflation is performing about like ours or maybe a little better, but they're not experiencing the kind of growth we're experiencing. So we actually have the luxury of having strong growth and a strong labor market, very low unemployment, high job creation, and all of that. And we can be patient, and we'll be careful and cautious as we approach the decision to cut rates, whereas I think other jurisdictions may go before that. In terms of the implications, I think obviously markets see it coming. It's priced in now, and so I think the markets and economies can adapt to it. And I think we haven't seen, in addition for the emerging market economies, we haven't seen the kind of turmoil that was more frequent 20 years ago, 30 years ago. And that's, I think, partly because emerging market countries, many of them have much better monetary policy frameworks, much more credibility on inflation, and so they're navigating this pretty well this time.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You sort of backed away from the notion that the economy would need to encounter pain for inflation to come back down. But given the sticky inflation data in the first quarter, can disinflation still happen along a relatively painless path for the economy, or is some softening in the labor market and the economy likely needed to bring inflation back down?
So you're right. I think we thought, and most people thought there would have to be probably significant dislocations somewhere in the economy, perhaps the labor market, to get inflation all the way down from the very high levels it was at the beginning of this episode. That didn't happen. That's a tremendous result. We're very, of course, gratified and pleased that hasn't happened. And if you look at the dynamics that enabled that, it really was that so much of the gain was from the unwinding of things that weren't to do with monetary policy, but the unwinding of the distortions to the economy, supply side problems, and also some demand issues as well. The unwinding of those really helped inflation come down. Now, as I've said, I'm not giving up on that. So I think it is possible that those forces will still work to help us bring inflation down. We can't be guaranteed that that's true, though. And so we're trying to use our tools in a way that keeps the labor market strong and the economy strong, but also helps bring inflation back down to 2% sustainably. We will bring inflation down to 2% sustainably. We hope we can do it without significant dislocations in the labor market or elsewhere.
And speaking of dislocations in the labor market, in terms of cutting, you said if there were weakness in the job market, that could be a reason to cut rates. So if the unemployment rate were to tick above 4%, but inflation not back down to your 2% target, how would you look at that? Would the unemployment rate popping back above 4% catch your attention?
I said an unexpected weakening is the way I characterize it. So, and I'm not going to try to define exactly what I mean by that, but it'd have to be meaningful and get our attention and lead us to think that the labor market was really significantly weakening for us to want to react to it. A couple of tenths in the unemployment rate would probably not do that, but it would be a broader thing that would suggest that it would be appropriate to consider cutting. And I think whether you decide to cut will depend on all the facts and circumstances, not just that one.
Chair Powell, thanks for taking the question. Kyle Campbell with American Banker. You've said that broad and material changes are needed for the Basel III endgame proposal, and you've mentioned that reproposal is something that's on the table. As you've had more time to sort of sit with the public commentary, process that, and understand the options available to you, do you have a better sense of whether a reproposal will be necessary? And do you have a timeline in mind for when some sort of movement will be made on that front, either a reproposal or a move to finalize?
So let me start by saying that the Fed is committed to, completing this process and carrying out Basel III endgame in a way that's faithful to Basel and also comparable to what the other large couple of jurisdictions are doing. We haven't made any decisions on policy or on process at all. Nothing. No decisions have been made. I'll say again, though, if we conclude that reproposal is appropriate, we won't hesitate to insist on that.
And then do you need to resolve issues with the capital proposal in order to advance other parts of the regulatory agenda, or do you expect to continue to make progress on those other agenda items?
There's no mechanical rule in place there, but I would say that the Basel III process is by far the most important thing, and really is, I think, occupying us at this time in terms of what we're moving ahead with.
Let's go to Mark for the last question.
Thank you, Mark Hamrick with Bankrate. Mr. Chairman, what can you tell us about the approach that you take with your role in the sense of trying to achieve consensus, which you recently identified as a priority, while allowing for a range of views or even dissent? We don't see many dissenting votes in the official statements, even when more spirited discussions are noted in the minutes after the fact. How do you avoid groupthink and avoid a higher risk of a policy mistake? Thank you.
So I think if you listen to, and you all do, listen to my 18 colleagues on the FOMC, you'll see that we do not lack for a diversity of voices and perspectives. We really don't. And it's one of the great aspects of the Federal Reserve System. We have 12 reserve banks around the country where they have their own economic staff, not the people who work here at the board. They're different people, and so each reserve bank has its own culture around monetary policy and its own approach and that kind of thing. It guarantees you a diversity of perspectives. So I think that the perspectives are very diverse. But and in terms of dissents, we have dissents, and a thoughtful dissent is a good thing. If someone really makes you think, that kind of thing. But all I can say from my standpoint is I listen carefully to people. I try to incorporate their thinking, or do everything I can to incorporate their thinking into what we're doing. And I think many people, if they feel that's happening, that for most people, most of the time, that'll be enough. But I'm not. It's not frowned upon or illegal or against the rules or anything like that. It just is the way things come out. And I think we have a very diverse group around the table, frankly more diverse than it used to be in many dimensions, more diverse both from the obvious gender and demographic ways, but also we have more people who are not PhD economists. So we have people from business and law and academia and things like that. So I think you actually do have quite a good diverse perspective. I think all of us read these stories about a lack of diversity, and we look around the room and say, I really don't understand what they're talking about. So, but I get the question now. Thank you very much.
All right, well, ladies and gentlemen, that looks like it is a wrap. Good old Papa Powell came out and did not drop the mic. If anything, he shot that to the north side, so it looks very, very well. But obviously, we can always come back down from here. That's a nice little pop right into the 21-day moving average. We'll see. We'll see. Are we going to sustain that buying power? It looks like here that most of us thought we were going to bleed red down that 45% said of us. Out of 11 votes, 45% said that we were going to bleed red. It looks like we popped up. Now, how are we going to end the day? Thank you guys so much for joining me. If you are just listening to this on an outside source, hit that like, hit that subscribe. We bring this to you all the time. We are everything economics. We bring you that bite-sized data, and we absolutely love to be here. So thank you so much for being here, and we will see you on tomorrow, and we'll do a YouTube short tonight just for you, okay? Just to review this whole last 2 hours. Thanks, guys. Peace.